Franklin Resources, ticker BEN on the NYSE. Founded in 1947 in New York City by Rupert Johnson Sr. as a one-room investment advisory, the company that became Franklin Templeton has managed money for institutional and retail clients for 78 consecutive years.
Today, Franklin Templeton manages $1.58 trillion in assets for clients in 155 countries across over 600 fund strategies spanning fixed income, equities, alternatives, and multi-asset management.
Charles Johnson joined the firm in 1972 and built it across the modern era. The 1992 acquisition of Sir John Templeton's legendary Global Fund Group and the same year's NYSE listing transformed the company from a domestic fund manager into a global investment franchise.
The 2020 Legg Mason acquisition for $4.5 billion was transformational, doubling AUM to $1.5 trillion and adding Western Asset Management in fixed income, ClearBridge Investments in equities, and Brandywine Global to the portfolio.
Jenny Johnson became president and CEO in 2020, the fourth generation of the Johnson family to lead the firm. A USC economics graduate who joined Franklin Resources in 1988, she worked her way through operations, Fiduciary Trust International, COO, and president before the CEO role.
Revenue breaks across investment management fees at 85%, performance fees at 5%, and distribution and other at 10%. Total revenue is $8.2 billion. The business is straightforward. Collect a percentage of assets under management. When AUM grows, revenue grows.
The challenge is that AUM is not growing. The business has experienced net outflows in 24 of the last 28 quarters. Investors systematically moving from active management to lower-cost passive ETFs. Adjusted operating margin has compressed from over 30% to 24.8%.
The alternatives build-out is Johnson's strategic response. Benefit Street Partners in private credit, Lexington Partners in private equity secondaries, and Clarion Partners in real estate provide exposure to the fastest-growing and highest-fee institutional asset class category.
On the competitive radar, Franklin scores 88 on dividend strength and 88 on net cash position, both leading the peer group. Its net flow momentum score of 30 reflects the structural headwind. T. Rowe Price and Invesco face similar active management pressures.
The balance sheet is the capital return story. $4.2 billion in net cash supports both the dividend and share buybacks, even as operating earnings face fee pressure. That cash buffer gives management time to execute the alternatives pivot before the fee base erodes further.
Franklin Templeton has raised its dividend for 44 consecutive years, paying approximately 5.5% yield. The dividend has grown from 80 cents per share in 2015 to $1.22 in 2024, compounding through the AUM pressure cycle.
Johnson's mandate is clear. Grow the alternatives platform fast enough to offset passive fund outflows while using the balance sheet to return capital and sustain the dividend. Both are happening. The question is pace and whether alternatives can reach sufficient scale.
Franklin Templeton has managed money for 78 years, survived every bear market, and still pays a 5.5% dividend yield, the kind of durability that value investors spend their whole careers searching for.
The AUM bleed is the thesis killer. 24 of the last 28 quarters with net outflows means Jenny Johnson is running up the down escalator, and the question is whether the alternatives build-out reverses the flow trend before the fee base erodes further. We dig into the numbers every quarter. Subscribe so you never miss a Charged Alpha deep dive. Franklin Resources just reported a quarter that gives the value case its first hard data point, adjusted EPS of 65 cents against a 60-cent estimate, an 8.3% beat, with quarterly net outflows narrowing to negative $12 billion, the best flow result in 6 consecutive quarters. The alternatives pivot is showing up in the numbers. We're breaking it down today.
Franklin Resources traces its roots to a one-room investment advisory in New York City, 1947, a company that has managed money through every market cycle for 78 years. With $1.54 trillion in assets under management across fixed income, equities, and a growing alternatives platform, It remains one of the largest active managers on Earth.
And today's central question is one that value investors have been debating for 5 years. Is the alternatives build-out moving fast enough to stabilize revenue before the chronic active management outflows erode the fee base beyond repair? Q2 FY 2026 provides the clearest evidence yet that the answer might be moving in Ben's favor.
Here are the Q2 FY 2026 headline numbers, covering January through March 2026. Revenue of $2.1 billion against the $2.02 billion estimate, a 4% beat. Adjusted EPS of 65 cents against 60 cents, an 8.3% upside surprise. Both lines beat, and the stock added 3.2% on the session.
AUM at $1.54 trillion, slightly down from $1.58 trillion at the start of FY 2026, but critically, the decline is slowing. Market appreciation in Q2 added approximately $30 billion to AUM, partially offsetting the net outflows. The combination of market gains and improving flow momentum is what drove the revenue beat versus expectations.
The net flows number is the most important data point in this quarter. Negative $12 billion versus negative $15 billion in Q1 FY 2026 and negative $18 billion in Q4 FY 2025. That's 3 consecutive quarters of narrowing outflows. It's not yet an inflection to positive flows, but the rate of deterioration is clearly decelerating, and that is what the market needed to see.
Revenue held at $2.1 billion because management fee rates, while still declining slightly at the blended level, are being partially offset by the mix shift toward alternatives. Alternatives AUM now stands at approximately $182 billion, nearly 12% of total AUM, but generates approximately 25% of total investment management fee revenue due to the premium fee structure.
The alternatives platform is the growth engine here. Alternatives AUM grew 9% year over year to $182 billion, with net inflows of positive $3 billion in Q2 FY 2026 alone. Private credit through Benefit Street, secondaries private equity through Lexington Partners, and real estate through Clarion Partners all contributed positive flows. This is the segment that changes the fee mix math.
Why does alternatives AUM change the economics? Traditional active equity and fixed income charge 20 to 30 basis points in annual management fees. Alternatives, private credit, secondary PE real estate charge 40 to 100 basis points depending on strategy and performance fees on top of that. Every billion of AUM shifted from traditional active to alternatives roughly doubles the management fee earned on that dollar of assets.
Adjusted operating margin came in at 24.3%, slightly below the FY 2025 full-year margin of 24.8%, but above the 23.5% that the street was modeling. The gap is closing as expense management tightens. Jenny Johnson has been explicit about the path to 26% operating margin as alternatives AUM scales and distribution efficiency improves.
Compensation expense, the largest cost line at 43% of revenue, grew only 1% year over year despite revenue growth of 2%, reflecting headcount discipline and performance-linked pay structures. G&A and other operating costs were flat. The operational leverage trajectory, while slow, is intact. Each incremental dollar of revenue from alternatives flows at above-average margin.
Net income of $425 million for the quarter, adjusted EPS of 65 cents, diluted over approximately 655 million shares. The share count continues to decline through buybacks, down approximately 2% from the year-ago level, adding roughly 1 cent per quarter of EPS from count reduction. Interest income from the net cash position of $4.2 billion contributed approximately $55 million pre-tax.
Cash flow. Operating cash flow of $380 million for the quarter, capital expenditures of $40 million. Asset management requires minimal physical capital, yielding free cash flow of $340 million. Against dividends paid of $195 million and buybacks of $150 million, Ben returned $345 million to shareholders, while maintaining the full net cash position.
The balance sheet is the most underappreciated feature of the Ben story. Net cash of $4.2 billion against a market cap of $12.1 billion means 35 cents of every dollar invested in Ben shares is backed by net cash. This cash position funds both the acquisition strategy and the annual dividend, providing a structural floor on the stock that pure earnings-based analysis misses entirely.
FY 2026 guidance from management, adjusted EPS of 255 to 275, implying approximately 8 to 12% growth over FY 2025. Alternatives AUM targeted at $200 billion by fiscal year end, a 10% increase from current levels. Operating margin recovery toward 26% as revenue mix improves, and continued monitoring of net flow trends with an eye on inflection in H2 FY 2026.
Let's address the passive versus active war directly, because it's the dominant bear thesis for Ben. Since the 2008 financial crisis, assets have shifted from active to passive at roughly $200 billion annually on net. Franklin Templeton has been caught in that tide. 24 of the last 28 quarters showing net outflows is not a company-specific problem. It's an industry-wide structural reality.
But active management is not dead. It's stratifying. The most sophisticated institutional allocators, sovereign wealth funds, endowments, large pension plans, are not buying index funds for their alternative allocations. They need private credit managers, secondary PE specialists, and real estate operators. The 40 to 100 basis points they pay for these strategies versus near zero for passive is by design. Ben's pivot into alternatives is capturing exactly this institutional demand.
The fixed income recovery thesis matters significantly for Ben. Western Asset Management, Ben's flagship fixed income unit, managing approximately $450 billion in AUM, has faced institutional redemptions following a difficult 2024. However, with interest rates declining and fixed income returns improving in 2026, Western asset strategies are generating positive absolute returns for the first time in 2 years, a prerequisite for flow stabilization.
Institutional client dynamics in fixed income are notably sticky. Pension plans and insurance companies that allocate to fixed income managers do so through multi-year mandates. They don't redeem after one bad quarter. Western Asset's client base is predominantly long-duration institutional, meaning the redemption cycle takes time, but so does the reaccumulation cycle. Performance recovery in 2026 should slow the outflows before accelerating them into the positive territory.
Western Asset's long-term bond performance, now recovering, is the key to Ben's largest AUM segment. If the 30-year U.S. Treasury yield remains below 4.5% through 2026, Western Asset's core strategies generate solid returns, creating the performance credential needed to reattract institutional mandates. Jenny Johnson specifically called out improved institutional RFP activity in the Q2 call.
Benefit Street Partners, Ben's private credit platform, is operating in the single best environment for private credit in a decade. With bank lending standards tightening and private credit filling the gap, Benefit Street's directly originated loan strategies are generating net returns of 12 to 14%. Each new deal done strengthens the track record needed to raise the next fund. This is a compounding institutional franchise.
International revenue held up well in Q2. Ben's 155-country distribution network provides geographic diversification that U.S.-centric active managers lack. Asia-Pacific institutional demand for alternatives was specifically highlighted on the call, with Japanese pension funds allocating to Lexington's secondary PE strategies and Middle Eastern sovereign wealth funds increasing private credit exposure. International is a net positive flow contributor for the first time in 4 quarters.
Let's talk valuation. At 1910, Ben trades at 8.2 times the forward EPS projection of 265 for FY 2026. The 5-year historical average forward multiple for Ben is 12 to 13 times. At 8 times, you're buying the world's 4th largest active manager at a 4 to 5 turn discount to its own historical average, with alternatives now representing 12% of AUM and growing.
Why has the multiple compressed from 12 to 8? The market is pricing in permanent structural impairment, that passive adoption continues indefinitely, that Western Asset never fully recovers, and that the alternatives build-out won't move the needle fast enough. Those are valid risks. But at 8 times earnings with $4.2 billion in net cash, the market is pricing in a scenario so pessimistic that even modest improvements would be dramatically underpriced.
Analyst Consensus, 15 analysts covering Ben, consensus price target of 22, representing 15% upside from current levels. 6 buys, 7 holds, 2 sells, more cautious than most quality compounders. The high target of 28 implies 47% upside, the bull case if flow inflection and alternative scaling occur simultaneously. The 2 sell recommendations reflect the value trap concern.
Net flows reach neutral by FY 2027. Alternatives AUM crosses $250 billion. Western asset recovers, multiple re-rates from 8 to 12 times. That's approximately $32 per share, 68% from current levels. Bear, passive adoption accelerates further. Western asset keeps bleeding. Fee base erodes below $7 billion in annual revenue. EPS falls toward $2. Stock drops to $12 to $13. The asymmetry here is unusual. The upside significantly outweighs the downside.
The key metric to track for the investment thesis is alternatives AUM as a percentage of total. At $182 billion out of $1.54 trillion, alternatives represent 11.8% of total AUM. At 40-plus basis points versus 20 for traditional active, when alternatives reaches 20% of total AUM, the blended fee rate stabilizes, and that's when EPS growth reaccelerates.
Why does this alternatives percentage metric drive re-rating? Because the market prices Ben as a declining active manager on zero growth. When alternatives reaches 15 to 20% of AUM, the revenue per dollar of AUM inflects upward. The market has to reassess whether Ben is actually a declining business or a transitioning business on its way to a better fee structure. That reassessment is the catalyst for the multiple expansion.
Options activity heading into Q2 results showed a put-call ratio of 1.1 above the neutral threshold of 1, indicating more put activity than calls. This reflects the cautious market sentiment around the flow trajectory. The specific puts, May 17, 700 contracts, represent investors hedging against continued AUM deterioration. The fact that calls at 20 also had 500 contracts suggests some conviction that the beat would be meaningful.
On insider activity, no open market purchases or sales post-earnings. The Johnson family retains approximately 14% economic interest through the company's share structure. Long-term alignment is intact. Institutional ownership at 62% is below peers, as index funds have reduced Ben exposure due to declining market cap weight. That institutional underweight is itself a contrarian setup.
Jenny Johnson's strategic execution is worth assessing separately from the macro backdrop. Since taking the CEO role in 2020, she has completed multiple alternatives acquisitions, built the private credit and secondary PE platforms from near zero, and maintained the dividend track record through the worst active management environment in decades. The operational discipline, maintaining operating margins above 24% while fighting structural headwinds, is a real achievement.
Catalyst 1: Fixed income flow recovery. With interest rates declining and Western assets' core long-duration strategies generating positive returns for the first time since 2022, the institutional redemption cycle is slowing. A rate-cutting cycle that extends through 2026 historically correlates with net inflows into active fixed income strategies, Ben's largest AUM category at approximately 45% of total.
Catalyst 2: Alternatives AUM crossing $200 billion at $182 billion today, and with the alternatives platform generating positive $3 billion in quarterly net inflows, the $200 billion milestone is likely within 3 to 4 quarters. Management has targeted this as a visible near-term milestone. Reaching it changes the narrative from declining active manager to growing alternatives platform with a legacy active base.
Catalyst 3: Net flow inflection to zero. The math is straightforward. If total net flows reach neutral by FY 2027, the AUM base stabilizes, the fee run rate stabilizes, and EPS becomes a function of market appreciation rather than structural erosion. With the Q2 FY 2026 result at negative $12 billion and improving each quarter, The trajectory towards zero is visible within the next 2 to 4 quarters.
Catalyst 4, accelerated buybacks. With $4.2 billion in net cash against a $12 billion market cap, Ben can buy back 35% of shares outstanding without touching the operating business. Management has indicated willingness to accelerate below $18 per share. At 5% buyback yield annually, the share count reduction mechanically adds 5 to 6 cents to annual EPS without any earnings growth.
Risk 1. Passive adoption accelerates further. If ETF market share gains continue at the current pace, $200 billion in annual net industry outflows from active, and Ben cannot offset through alternatives growth, the fee base continues eroding at 3 to 5% annually. In that scenario, EPS growth is negative regardless of market level, and the stock deserves to trade at a discount to historical.
Risk 2. Western Asset continues bleeding. Western Asset's reputation took a hit from its 2024 positioning controversy around the interest rate outlook. Even with performance recovering, institutional clients that redeemed require performance track records of 12 to 24 months before reallocating. The reinflow cycle is measured in years, not quarters. The Western Asset drag could persist through FY 2027.
Risk 3. Rivals are better positioned in alternatives. T. Rowe Price, Invesco, and affiliated managers. Ben's primary rivals in the transitioning active to alternatives space have all been building alternatives platforms for longer and have stronger performance track records in private markets. Apollo, Ares, and Blackstone are already alternatives dominant and capture the institutional mandate flow that Ben is targeting.
The counter-argument on alternatives competition. Ben is not competing directly with pure-play alternatives managers like Blackstone. Ben's differentiation is the combination of alternatives with its global distribution network in 155 countries and its retail wealth channel relationships. The alternatives plus distribution combination is increasingly valuable as institutional alternative strategies get democratized into retail wealth accounts. That's Ben's structural opportunity that pure-play alternatives firms lack.
The dividend sustainability question needs to be addressed directly. Ben pays $1.22 annually, a 6.4% yield. The payout ratio at 47% of adjusted EPS is well within sustainable territory. Even if EPS declined 20% in a worst-case scenario, the payout ratio would still be below 60%. And the $4.2 billion net cash position covers over 5 years of the current annual dividend payment outright.
The net cash position is the dividend's ultimate backstop. At $4.2 billion in net cash versus $780 million in annual dividend payments, Ben has over 5 years of dividend coverage from the balance sheet alone, independent of any operating cash flow. 44 consecutive years of annual dividend increases is not a streak that management would risk unless the business is in terminal decline, and the evidence suggests it's not.
The value trap versus value stock debate is the core disagreement among analysts. Value trap: the structural decline in active management is permanent. Ben cannot grow fast enough in alternatives to offset the fee erosion, and the dividend grows at 1 to 2% while the stock drifts lower. Value stock: the alternatives build-out inflects the fee mix by FY 2027, Western Asset recovers, flows stabilize, and the multiple re-rates from 8 to 12 times.
How do you know if this is a value stock versus a value trap? Watch 3 signals over the next 3 quarters. First, does alternatives AUM reach $200 billion by FY end? Second, does quarterly net outflow narrow below $8 billion? Third, does Western Asset report a quarter of net zero outflows? 2 of those 3 signals in the next 9 months, and this moves from the potential value trap bucket to the unambiguous value stock bucket.
The net flow inflection signal is the most important of the 3. When flows go from negative to flat, the narrative changes entirely, from how long until the business runs out of AUM to manage to what's the earnings power when AUM stops declining. At flat flows and $1.5 trillion in AUM, the EPS power with 12 to 13 times multiple is $15 to $20 per share. That re-rating from 19 to 15 to 20 is a 50% move.
The net cash versus market cap framing deserves emphasis one more time. At a $12 billion market cap with $4.2 billion in net cash, The enterprise value of Ben's actual operating business, the AUM platform generating $1.3 billion in adjusted operating income annually, is only $7.8 billion. That's 6 times operating income for a franchise managing $1.5 trillion. On a pure EV to earnings basis, this is one of the cheapest asset managers ever.
Lexington Partners, Ben's secondary private equity platform, is particularly well positioned in the current market. As private equity portfolios from the 2020-2022 vintage start coming due, limited partners are using the secondary market to rebalance or exit positions early. Secondary PE buyers like Lexington purchase those positions at discounts, locking in embedded returns from day one. This is a cyclically advantaged strategy in the current LP liquidity environment.
Clarion Partners, Ben's real estate platform, has the benefit of a historically long cycle to rebuild real estate performance as interest rates normalize. Commercial real estate values, which declined 15 to 20% from the 2022 peak, are beginning to stabilize as financing costs ease. Clarion's core open-end real estate fund, which saw redemptions in 2024, has seen those redemption queues begin clearing as the rate environment improves.
What does a buy look like for Ben at current levels? At 8.2 times forward earnings with a 6.4% dividend yield and a 5% buyback yield, the total income return alone is 11.4% annually. Add 5% expected EPS growth, and the base case total return is 16% per year before any multiple expansion. For a 44-year dividend grower at a multi-decade low multiple, that's compelling.
3 numbers to watch for Q3 FY 2026, July 2026 reporting. First, total net flows needs to narrow below $8 billion or the inflection thesis stalls. Second, alternatives AUM needs to cross $190 billion on the path to 200. Third, Western asset net flows specifically. This is the biggest single variable determining whether the total flow number improves or the alternatives gains get overwhelmed by fixed income redemptions.
For Q3 FY 2026 specifically, consensus models adjusted EPS of 67 cents, roughly in line with Q2's 65 cents. The flat expectation reflects market uncertainty about whether Q2's narrowing flows represents a sustained trend or a one-quarter anomaly. If Q3 shows further flow improvement and alternatives AUM at $190 billion, the FY 2026 EPS guide goes up and the stock follows.
The total return math at current levels is the most straightforward argument for Ben. You collect a 6.4% dividend, among the highest in the S&P 500 financial sector, while waiting for the net flow inflection thesis to play out. You don't need the stock to re-rate to generate a market-beating return. The income alone, with 5% EPS growth, delivers returns that most investors would accept for a company of this quality.
At 8 times forward earnings for a company managing $1.54 trillion, generating over $1 billion in annual free cash flow, holding $4.2 billion in net cash, paying a 6.4% dividend with 44 consecutive increases, and building the alternatives platform that addresses the industry's structural shift, the combination of income and optionality is unusual at this price point.
Bull case target. If Ben re-rates to 12 times FY 2026 EPS of $2.65, fair value is approximately $32, 68% from current levels. That requires flow inflection and alternative scaling to be convincingly underway. Maximum upside at 14 times the peer group median is approximately $37, 94% from here. The income yield while you wait makes the holding cost effectively zero.
Bear case. Passive adoption accelerates. Western asset continues bleeding. Alternatives growth isn't fast enough to offset. EPS declines toward $2. Multiple contracts to 6 times. That's $12 to $13 per share. The bear case is real, but is largely already priced in at 8 times earnings. The current multiple assumes very little will go right from here.
Why are we constructive on Ben here? Because Q2 FY 2026 is the first quarter where multiple metrics moved in the right direction simultaneously. The EPS beat, the flow improvement, the alternatives growth, the balance sheet provides the margin of safety, the dividend provides the income floor. and the valuation at 8 times earnings prices in an outcome significantly worse than what the data is showing.
We'll close with Jenny Johnson from the Q2 FY 2026 earnings call. She said, "Our results demonstrate that the diversification and alternatives build-out we have been executing is stabilizing our revenue base. The improvement in net flow momentum reflects the quality of our institutional relationships and the growing demand for our alternative investment capabilities. That's the thesis. That's the turn. We'll see you next time on Charged Alpha."
This content is for informational and entertainment purposes only and does not constitute financial advice. All investments carry risk, including the potential loss of principal. Past performance is not indicative of future results. Always consult a licensed financial advisor before making investment decisions. Charged Alpha is not a registered investment advisor.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.